Hello, everyone. Welcome to the fifth mentorship session of Investment Challenge August edition CMT Associations. And we have our mentors for the day with us, Sandra Stoutenburg and Sovit Manjani. Both of them have been active and supportive CMT members. So thank you so much for joining us today. And as you know, we start the session with our introduction of our mentors. So, Sandra, would you like to start the session by introducing yourself?
Sure. So I am an economist. I've been working in the banking industry for some time. I worked on a newsletter for about 13 years here in the United States that looked at market outlook. It was also a company that managed personal money for other people. And I've been a CMT since 2011. I like to trade independently. Have not done that in the last couple of years due to caregiving responsibilities at home. However, I do have a big interest in quantitative approaches to the market. And one of the reasons for that is I feel the behavioral side of trading is challenging, to say the least. And I believe that the quantitative approach will help traders, hang on to their money, so to speak. So, 15, 20 years experience in the industry, just coming back now. So that's me.
Thank you so much, Sandra. And I'm so glad you mentioned the quantitative approach because that's something that we need for more folks to kind of understand. And it's brilliant that you and Sovit are the mentors for today. I can see that Parth has joined us as well. Parth will bring you in a moment. But Sovit also has built his career on the quantitative side of trading and the financial markets as a whole. In fact, Sovit used to also run one of India's most prominent algo trading conventions as well. So let's bring you into this conversation. We know each other and we've known each other for a long time, but for the benefit of everyone who's watching the call and who will be watching the recordings as well once this is done, can you give us a bit of a background about your own career and how you came to this stage in your life?
Yeah. So basically, I did CMT in 2013, and since then I've been a successful systematic trader. I have various firms. Okay, so I am a CEO of Yubha Trading Heads, and I also have a partnership in a company called Equanimous Edge and Dhananiti. Okay, previously I was a partner in Dravaniti Consulting and Algo Convention, as you mentioned. Right, you have been part of Algo Convention many times as well. Yeah,
Absolutely.
and right now I'm just focusing on my own trading. Okay, and I teach for CMT, I coach for CMT. Plus, I do some consultancy. Like I have only one consultancy job. That's it. So these are three aspects on which I'm working. Other than that, I am not doing anything else.
Wonderful. So, just for everyone's benefit, Sovit runs two training brands in the world of technical analysis. Yubha is focused specifically on offering prep services for the CMT program, and Trading Heads is more general in nature. So, do you want to maybe talk to us a bit about what Trading Heads does?
Trading Heads is basically into a systematic trading, coaching of systematic trading, using basically algorithms. There are multiple softwares like AmiBroker, Python, PineScript, right? So we provide training for all of those. Like there are separate mentors for separate these things. Plus, we are also coming up with an options trading workshop. Okay, so all these are under the brand of Trading Heads, and CMT coaching is under Yuva. Basically.
That's it. So great, thanks a bunch. And we have Parth as well who's joined us. You've had a good streak, Parth, in this investment challenge where you've been the top performer week after week for now 3 weeks now. This is your
Yes,
third appearance. Congratulations.
this is the third appearance.
Well done, well done. So that's
Thank
always a
you.
good thing. And such kind of success is always something that everyone else would like to learn from as well. So let's maybe partly you just introduce for Sandra and so this benefit a little bit about yourself, and then I'll turn this over to you to ask your questions of the mentors as
Okay. Uh, so I'll just start. Okay. So hello everyone. So my name is Parth and I'm doing my MBA from Samaya. So I would say that I started like learning about trading. It's been like around 1.5 years back. So I'm just in the beginner phase right now. Don't know much. So I'm trying to like learn the different techniques and how we do it. And this CMT has been like really good. So we like in our college are also discussing with our peers. So that is something the learning that we are getting at this time, which we like lacked before when everyone that is like taking interest in the CMT challenge and we're discussing our trades and like trying to learn from each other. So yeah, this is about me.
Great.
well. Wonderful. Wonderful. So great. Let's turn the baton over to you, Parth, and maybe you can start by asking Sovit and Sandra any pressing questions that you have in mind, whether it's about your performance in the investment challenge itself or about your trading in your career in general.
Yeah. So one question that I have in mind is like sometimes you take a trade and maybe you think maybe if I'm looking at a support and resistance and then maybe I think that it's gonna break and it doesn't like so like how would you analyze like what went wrong, like what should be the steps after a trade doesn't go in your direction, like what should be done after that?
Hmm. Well, I might just jump in and make sure that I know the question. The question is, if you have a trade and something goes wrong, how do you analyze it after the fact? Is
Mm,
that
mm.
correct? Yeah.
Yes, yes, exactly.
Okay. One of the things I feel, and I personally have experienced in doing that, is you can overanalyze a trade, and you can also find yourself going down a different path. Maybe I need a different indicator. Maybe my time frame isn't right. All of those sorts of things. And in fact, it could be just what we would say an exogenous event that influenced your trade. And so I think perhaps to be aware, not to step away from your process quickly when you're trying to analyze what went wrong. That would be one thing. um, Obviously we look at our process and we change it over time, but you can find yourself going down different avenues that may not be appropriate or productive for what happened in your trade, because it may be nothing related to your process and everything related to some outside event in the world that would affect either the index or the company that the stock you have. Um, so you have to look at it and just kind of try and understand what the psychology was. I think that's one of the more important parts of it. Is what was the psychology for you going through that trade, and did you get out soon enough? If it was going against you, those sorts of things are questions I think perhaps need to be answered before changing your indicators or doing that sort of thing. So that would be my thought.
Okay. I can add a little bit here. Okay. So firstly, you'll have to see whether that event that happened, like if your stop loss was hit and you exited, okay, or if the trade didn't work actually. So you have to see whether it was because, as Sandra said, whether it was an exogenous event, it was because of exogenous event, or it was because of your miscalculation, right? Or it was just luck, right? So you have to see if it went against you, if there was sudden news which came in, or whether there was something like say the index went down for some reason, okay, or you have to see what happened. Okay, that is one thing. If it was a particular event which triggered your stop loss or which made that trade unsuccessful, okay, it can be just because of luck. Okay, it has nothing to do with your process, as Sandra said. Okay, and it was luck. And if it was not luck, and if it was something which you can predict, okay, so you have to see that where you did wrong. Okay, what did you miss to see? Okay, first thing is that you have to see whether you have a process or not. The most important thing that firstly you have to have a process, and you have to also understand that process cannot be built in one day. Okay, if you are doing algorithmic trading, then of course you can build it by doing making backtesting and all. But if you are doing discretionary, then you have to have multiple trades in the same setup. Okay, and multiple trades, I don't mean by multiple trades it doesn't mean five ten trades. It should be more than say 100 trades or 500 trades. Okay, and doing that manually is extremely difficult, but people do that. Okay, you have to have at least a law of large numbers to support that process, to support that setup. And after and if that setup is successful in 500 trades or 100 trades, okay, and still if it is going wrong, then it can be more because of a luck or an exogenous factor. Okay, then you do doing anything. So if you have tested it either by back testing or by manual testing of the back of the uh, like previous data, then just ignore it, because it is just because of luck or because of an external factor. Okay, but if it is happening regularly, okay, then you'll have to check your process also. Okay. So it is a tricky question actually. The best answer we will get it from the back test actually. Okay, and whether if you think that say by adding an indicator it can be improved, then backtest it with that indicator. Okay, so whatever idea you get, you have to test it on a large number of sample size, right?
I have a quick question for you, Sovit, on this issue of backtesting. Right? At what
Yes.
point does backtesting lead to overfitting, especially in the early stage of your careers when you try to come up with a trade idea or strategy, any kind of setup? Uh, Backtesting helps us to find out whether the setup we're trying to make sense, and we start refining it to a point where we know that it gives us a consistent return based on our premise. At what point does that spill over into overfitting and trying to optimize the trade to a very specific set of conditions, which are very delicate and likely to change?
So firstly, that situation should never come.
Mhm.
Okay, that is what I believe, and it is possible. For backtesting also, you have to follow a process. Okay, you have to have a checklist that these things I have to do for backtesting. Okay, like you have to have a law of large numbers, like at least
Ah,
500 hits I need in the backtest. Okay, another thing is that you have to have less number of rules. If you have a lot of rules, okay, then it's a problem, because rules will filter out a lot of trades. If a rule is very general and still it is making money, then that is a more robust rule. It is a more robust system. So I personally prefer just having one or two rules, or maybe three rules. I do not keep like too complicated, like five, seven, eight rules. Okay, generally my rules are like single rules. Many times I prefer only one rule, one rule for entry, one rule for exit. That's it. Okay, uh, and such systems I personally believe there's nothing to optimize only, right? If you have say one indicator, then you will have only two parameters. Say RSI, right? If RSI, say the rule is simple that RSI, if it goes above 50, then I buy. If it goes below 40, then I'll exit. Just a simple example. If this is the rule, okay, what can you optimize in this? You can optimize the period of RSI, right? You can optimize the levels of RSI like 50, 60, 70, or you can exit for the exit. You can optimize the exit level like 40, 30, 10, whatever, right? So these are the only three parameters which you can optimize. So there's nothing much you can do. So automatically, if your system is made by that, the probability of it having curve fitting is extremely low, right? And you follow a process. Always start with one rule at a time. Okay, don't make a system which has RSI also, MACD also, moving average also, XYZ indicators also, 10 indicators together and making a system. It will give you a curve fitted result only. because too many filters will remove a lot of trades. Okay, and you will on the face of it will look that works, but in the real life it will not perform. And also understand, each indicator which you are adding, it should have a reason, right? One indicator is for trend, another maybe can be for momentum, third can be for volume, fourth can be for xyz reason, for stop loss. So each indicator if you're adding, it has to have a reason. Okay,
And
it has to have a logic, and it should be unique, right?
right,
Say adding MACD and RSI both doesn't make sense,
No.
right.
because both are momentum indicators,
Yeah.
right? Many people I see, they will put RSI also on the chart or on the backtest. They'll put stochastics also. They feel that it is confirming the signal, but it's not confirming. They all are going to show you the same thing because they are all gauging the same thing, which is momentum,
Right.
right?
Right. I would say that it's and I personally have overfit in backtesting. I think that's, you kind of have to experience that yourself to understand just how good you can get at overfitting, and it does happen. That's one thing. I think too is you can create your system, and then on a certain a certain data set, and then you need to walk it forward to see how it will perform. So you have data that's outside where you were creating your algorithm, and all that kind of thing. That's very important. The other thing, well, two maybe, um, context is very important. And if you are creating an algorithm in a bear market, it's probably not going to be maybe a good thing in a bull market, because the dynamics are very different. So, what indicator you choose to use will have a certain profile in a bear or a bull, or in a sideways move, right?
Which is what we're
So,
seeing these days all around the world, isn't it?
yeah. So that's one thing, and then the other thing I would say is that yes, I agree with the law of large numbers. You need to have a number of trades. However, I would not go back too far in time, because the structure of the market changes rapidly, and so one has to be aware of how your logic uh, is going to adapt to a change in market structure. And if you go back too long, you might be working on a market structure that is no longer valid in today's world. So those would be my thoughts on that.
Um, I'll just ask one more question. Parth, I'm sorry I'm taking your time up as well. But do you have, say, a golden period, a recommendation for how far back should go beyond which markets would change significantly? The market structures would change. 5 years, 10, 15?
I think, and Sovit, please jump in, but I feel that it depends on the time frame that you actually are using. If you are a person that is trading intraday, going back 5 years is probably not appropriate, right?
Absolutely.
And if you're trading, if you have a longer term perspective, then you would want to go back a couple of years, right? So that would be, it would depend on your time frame. Honestly, I don't think you can say a certain number of years. You really, the law of large numbers is pretty important in terms of having enough statistical confidence in what you're doing. So
Which makes
that
sense.
would be.
Thanks so much, guys. Parth, back to
So
you.
yeah,
So,
for me, the bigger the data, the better it is. Okay, because what I believe is that if something has happened in the past, it can always happen in the future. Okay, whether many people say that, yeah, say 20 years back there was no computers, there were no automation, algos were not there, so that data is not relevant now. But I personally believe that if the human psychology is the same, right, it doesn't changes too much, right? Yeah, the speed has changed, okay, the liquidity has changed a lot, okay, all those things are there, but anything which has happened in the past, it can definitely happen in the future. At least for the drawdown purpose, you should see the beta as long as possible. okay, because it can always happen in that. But the most important thing is that uh, is the data has all the phases of the market. Like generally we know that there are three phases, right? Bull market, bear market, and sideways market. But I personally feel that there are at least six phases, and they may be more also, because we have seen bull market with high volatility, we have seen bull market with low volatility. A
Mhm.
system which works very well in a bull market of high volatility may not work very well in a bull market of low volatility. Same way, there can be a bear market with high volatility, the bear market can be with low volatility, right? So, and systems which do not work very well with bull market with low volatility may work very well with bull market, sorry, bear market with high volatility. For example, I'll tell you, we had a system which was long shot system. It gave very good results in the back test. But in the bear market of 2021, okay, so the COVID bear market, it did perform very well. The reason was that it was a retracement based system, and the bear market of COVID, it came suddenly and it started to fall vertically down. So there was no retracement there,
Mhm.
right? So it didn't perform that well. Another system, which was also a long short system, it performed very well in the bear market of COVID, because it was a breakout based system. And once the breakout happened, it continued to go down, 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 and it captured the entire trend on the downside, right? So uh, systems, although both were long short systems, the performance differed because they preferred their style was different. Okay, so you have to see these things also in consideration when you are developing a system.
I would agree with that. I think that if you look at how a bear market ends and a bull market starts, it can be very different. And some of your standard indicators actually have too much of a lag in that sense, and so by the time your indicator is giving you a signal to buy into an early bull market, it's already gone up a fair amount, and this is where the psychology comes in, because if the market has already come up off the bottom, and typically that happens, in a V shape, um, then in your head you're saying, well, have I missed it? Should I do this? It causes some degree of your own questioning on that. So I think that Sovit is quite right. There are different phases to the market and different ways that those things happen. Um, and if you look at early bull markets, they tend to be fairly volatile, and they tend to have a fair number of 5% corrections in them, and and that scares people, because maybe they've just bought in, they've waited a period of time, and they've just bought in, and now they're down 5%, right? So I do think so. It is quite right, in terms of understanding what phase of the market you are probably in. That would be the thing. Um, so
That's
I
very important, Sandra.
Yeah.
As you said correctly, a system which uses a short-term indicator, okay, can take advantage of V-shaped recovery and give you good performance. But a system which has a longer-term indicator, like something like a weekly time frame or a monthly time frame, it will lag to give
Mhm.
you the first signal, because at least that many data points should happen in monthly time frame or weekly time frame. So it will not catch that V-shaped recovery, but it can perform better when the market goes down, remains sideways for a time, like 2008 market crash in India. At least market went down, it remained in sideways zone for a very long time, for around 4 to 6 months, okay, and then reverse from there. So such systems will do better where there's a base building. Okay, there's not a V-shaped recovery and base building. So some systems will capture that, some systems will capture the V shape. And if you have a V-shaped system in this base building, it will give you a lot of losses, because there's a base building where it will give breakouts, and these breakouts will fail down, right? So each system may not be able to capture all market dynamics. Like the markets can have different shapes.
And I would also add, particularly for individual stocks, when you're looking at stocks within an industry, it's really important to look at the character of the stock or the profile of the stock in terms of how does it build long basis? Does it build only short basis? Has it been a great performer and during a bear market, as an example? Has it held up fairly well? And I think those are also really important pieces of information that would help you choose the appropriate quantitative approach to that particular stock. So it is the character profile also of the stock and the industry, but mostly I think in the stocks is where you're going to get large differences in those profiles.
Wonderful. Thank you so much, guys. This was a very nice conversation, and I think there's a lot to take away for everyone who's watching the session as well. Parth, back to you for your next question.
Oh, okay. So something I wanted to ask is that so we can learn about fundamentals, we can learn about technicals. Like, but as like, what characters should we have? Like our behavior, like how we should be in order to make sure that we are like doing good in the stock market. What characters we should have attributes.
So basically, the most important character is the patience. You have to have patience. Okay, because whether you have a short-term system, whether you have a long-term system, any system will take time to show its performance. Okay, in live market, when you go with a system, whether it's tested or it's not tested, whether it's coded or whether it's not coded, okay, you will have losing phases. Okay, it's not going to happen. There's no system which will have 100% win rate.
Mm-mm.
Right? On the back of it, our mind is always asking for a system which has 100% win rate, but it doesn't exist. Okay, so even if the system has 70% win rate, 30% of the time it is going to go down, and this 30% of the time can have a big series of losing trades. Okay, there can be 5, 10 consecutive losing trades also. If you if you and you will definitely have that sooner or later. If you stop the system at that moment, you will not get the benefits of that system,
Yeah.
right? So for that, you have to build your psychology. Okay, you have to understand that there will be losses. The only thing which is in our control is to restrict the losses to be small. Okay, the losses should not become big. Okay, the series of losses is not in our control. It is dependent upon your win rate. Okay, if your win rate is high, your series of losses will be shorter. Okay, but still there's no guarantee that will not go beyond a certain point. I have personally seen 45 consecutive losing trades. Okay, people will not be able to digest such losing streak. Okay, so for that you have to have patience and you have to have faith in your system, and that faith will come only by either you being have backtested that system, or you have seen that system work for a very long time. Okay, that will build the faith in the system. Otherwise, sooner or later you will stop the system. Okay, and if you stop it, you will end up in a loss, right? And you will never get the benefit of its winning streak.
I would agree with that. I think that the concept of having even 80% system to me is I'm a trend person. I like momentum and things like that, but even 80% is unbelievable. What's causing 80%? Are you missing something? And there are quantitative systems out there that can even be maybe even less than 50% on the win rate, but they come out ahead on the money rate because of the way the risk is handled and the way the losing trades are kept, small. And we all want small losing trades and really big long-term trades. But in fact, from my perspective, that's how you make the money is staying with the longer term trend. And long term is germane to what your time frame is. But to stay with it is where you're going to make your money. It's very hard to do that because you have profit and you want to take it off. But if you take it off too soon, then well, if your system takes it off too soon, then you will need a higher win rate. So it's all about maintaining and minimizing your losses. And I agree with Sovit. Um, if you have a system and you know it's robust, you have to stay with it, because as soon as you stop, you're going to experience that winter trade that you're not in because you stopped. And so you do have to have patience. And then the other thing is, sometimes if you need to take a break, just step back for a bit, and just let your perspective normalize, shall I say? Because we can get stuck in, 8 or 9 or 10 losses in a row, and that can be hard on you, psychologically speaking, right? So it's important to patience, calmness, but that's it. It's pretty important, and that's very hard. I will say it's very hard.
especially for young kids.
Yes.
Okay, I had an advantage that I started systematic at the age of say 38 or 39. So I was matured enough. Okay, nowadays I see young people now the practicing and all these things are very easy now, because now you have ready-made softwares, right, which can backtest for you. You don't even need to do coding, right? At that time, those things were not there. So, but when you have a system like that which can code for you, or which can on which you can test, uh, we just think it like a video game, right? And it's not that easy. Okay, you can make systems, but generally, what these ready-made tools give you is a very small piece of data, like a 2 years data or a 3 years data. In most cases, this data is not enough. Yeah. So no matter whether you have a 5 minute system or a 1 minute system, still 3 years it will not be enough data, in my understanding. Okay. So you will have to have patience. Okay. It's an extremely important, because if you have to capture the long fat tails, you will have to have patience. Okay.
Mhm, mhm,
And fat tails and the outliers are where the money is. Okay, and statistics tell you that fat tails should be ignored. Okay, but that's not true. In trading, you have to have fat tails, and those outliers, few
mhm.
of them, but they can be extremely rewarding.
I think that's a very good point, and they are rewarding, and that is where you wind up with a good profitability in your system. And yeah, in New York, they had one of the turtle traders on there, and basically, the message was, and they quantitative in their approach, trend following, was not to deviate at all from their system. They just didn't. The one thing I did notice is that they diversified over a wide number of different asset
Exactly.
classes, and so that's kind of where they, I think, well, this one particular individual smoothed out the risk to some degree, but basically the message was, stick to what you have, and patience is important. It's bottom line. It sounds so simple, but it isn't. That's very simple.
Uh, okay, let's ask the next question. So, just like going towards a little bit of Indian market, like we can see nowadays there's a lot of retail investors and there's a lot of speculation going on right now, and like it could be like a bubble or something. So, how can we like really safeguard ourselves in such situation where we feel that a lot of speculation is happening right now? Like, what should we do? Like, should we like not
Uh,
trade at all, or how should we do it?
See, Parth, understand one thing, that there will always be these things. Okay? There always be noise. There'll always be people who will say that this is bubble, that is bubble. Okay, there'll always be like trends, and trends are like that. That they look like bubbles. Okay, and eventually they will the bubble, if it will burst. That is fine, but you don't know at this moment whether it's a bubble or not. Okay, let the price show you that. Okay, you'll have to be reactive rather than predictive. Okay, because if we don't know, a stock can go to 1x or 2x or 10x. We have no idea. Okay, personally, at the moment, I don't think it's a bubble in Indian markets. Okay, people will always come on television and say we are overbought, or we are this, we are that. Yes, we will correct in the bull market. Okay, there will be noise, there will be speculation. You have to deal with it. Okay, you have to learn to deal with it. And what I personally do is that I just do not see the television and all those things. Okay, because all this is noise. In fact, I would say one thing, that if you have a system, okay, and say suppose you have two systems, okay, one systems give you a buy signal, and it is possible that another system gives you a signal in the same security. Okay, so what the signal of one system is noise for another system. Understand that? So you have to have faith in your system and keep running it. If you're backtested for a decent period of time, if you have seen all these phases, ups and down phases of say 10 years, 15 years, okay, then you should not be worried about these what noises are coming from the market. Okay, just follow the system, follow the process basically. Okay, and ignore all these things, and they will disturb you initially. You are new, so these things will happen. But maybe keep a note somewhere at your place, that everything other than my system is noise for this system. Okay, so and if it turns down, fine, your stop losses are placed. If you are following your stop losses, why are you worried? Right, one of the student came to me, and he said that I've exited everything. See, 3 months back he came to me, and my systems were giving profit of more than 30% in 3 4 months, so I exited everything. Okay, uh, see, you cannot predict these things. Okay, see the charts of 10 years, 20 years, not 10 years, 20 years, I would say see the chart of 40 years. In India, you will see charts of BSC stocks of more than 40 years. In US, you will get 100 years of data also of some stocks, maybe 50 years of data. See the chart of Nikkei, see the chart of Dow Jones, 100 years chart you will get on TradingView. Okay, see those big charts, and that will tell you that stocks trend, and they become multi-baggers. Why are we afraid with a 10% move or 20% move or 50% move? Okay, the stock moves by 50% or 100%, people just start screaming that okay, it is overbought, it is overbought. Okay, stocks go to 10x, 20x, 100x also. Okay, so ignore these noises. If you, and this is possible only if you are a trend follower. Okay, if your mindset is of mean reversion, then obviously you should take your profits. Okay, I don't know what is your mindset, so you have to understand yourself. Okay, nobody can tell you who you are. You have to find it. Okay, that is a research which you have to do. Okay, nobody can tell you. If it is, if 10 point doesn't suit you, then don't do it. Okay, because you will not be able to make money out of it. Okay, but if you can, then there's nothing better than 10 following. Okay.
Yeah, I would also I would add predictions are not helpful in any way because you just don't know what is ahead. The only thing you can do is gauge how the market is reacting or working. But I think the concept of overbought, things can be overbought for a very long period of time. And if you are looking at, I don't know, take Adobe as an example. I mean, that stock has just been amazing. It's just, yeah. And if you were to get out every time it was overbought, you would miss out on a lot of the great, profit that has been built into that stock over time. And so um, I tend to not necessarily look at the actual level of if it's overbought at 70 or whatever. but more the profile of, is this stock a stock that stays above 50 continuously in an RSI over periods of time? It's a very strong stock. So what if it goes above 70? Well, it could stay there for some time. And there's no prediction to when it's going to drop below 70 and come back down again. You just can't predict that. And that's one thing I think that quantitative approaches allow you to go with the flow of the market. And that, I think, is the real key to that, is to be able to do that. But it's a personal thing in terms of what kind of approach you're taking. It's very personal. And to get comfortable with that is also takes a little time to understand how you feel about it.
Okay. Thank you so much. That was really insightful. Uh, Another question is that I would like really would want to know like all the options with respect to job. So I'm doing MBA and I'm interested in share market. So like what all opportunities are there? If you could like tell me a little bit about that.
Okay, for Indian markets, I can tell you. For US markets, and I can tell. Okay, so in Indian markets, the very basic and very easily you'll get jobs with stockbrokers, right? But personally, I will not prefer them, because those job profiles, what will they give you? They will ask you to write a report, maybe on a particular stock, or maybe on a index, okay, or maybe some macroeconomic things, okay. Um, Personally, these all are predictions which we are doing, right? You'll have to give a target, you'll have to give a stop loss, okay, and it will be a boring thing. Sooner or later, it will become boring for you, okay. Also, people do not follow these things. You'll give a recommendation, you'll give a recommendation that you buy at 100, sell at 120, a stop loss of say 90. You don't follow it, okay. If they follow, even if you have done a good research, they will not follow it. Okay. So I am not a good believer in such things. Okay, and you also have to maintain a high win percentage in such jobs, which is very difficult if you keep a long target, like, or if you and you cannot give a call without a target, right? So that is all against trend following. Okay, so personally, I'm not a great fan of that. Okay, what I would suggest is that if you can get a job, initially you can take whatever job you get. Okay, but if you can get a job in a hedge fund, or if you can get a job on the buy side where you are allowed to trade, maybe they provide you some funds, okay, a proprietary desk, okay, where you will learn also, and you can make money as well, and you will get a percentage, and you'll also build your psychology, because when they give you such money, they also test you. Okay, they will not give you a big money just for no reason, right? And if you're not good, then they will not give you big money. They will give you a very small money, and then kick you out if you are not good, right? So personally, if you're getting some job in a hedge fund or on buy side, okay, it's always better, or in a PMS, okay. There are a lot of PMSs there in India, okay. Mutual funds also, if you get, yeah, it's good. At least you learn fundamental analysis, okay, and a lot of new things you can learn from there, okay. um, so, and if you get something in quantitative field, like building algos, building quant models, that is the best thing I can say. If you can learn languages like Python, maybe me broker, maybe PineScript, uh, you then become a data scientist. So you can generate ideas from the studies you have done in CMT, and if you can add on to coding skills, database management, and all those things, okay, then you really become a data scientist. Okay, now you're going into the data and searching for models. You're not searching for ideas of say whether I should buy XYZ stock, but you are building an entire model which will give you the ideas. Okay, So that is what is I call research. I don't call research this stock I should buy or that stock I should buy. That is not a research as per my understanding. Okay, when you make a model, that is a actual research. Okay, and then this model will generate alpha for you in the long run, right? And you can make multiple models, not only in equities. You have equities, you have bond markets, you have currencies market, you have commodities market. Okay, there are ETFs. There are a lot of things on which you can build models. Okay, multiple assets, you can build models, and that is the uh, path which I at least tell my students that they should target. Okay, but it's a long journey. I understand it will take at least 7 years. It's don't expect that you'll get results within 1 or 2 years. That's not going to happen. Even if you clear CMT all 3 layers in one attempt, it will take at least 3 to 5 years, at least, I would say. But it's really rewarding. I'll tell you, if you do it rightly, there's no limit to it, of
Um,
knowledge and of making money.
yeah. I think it is a long-term career. So it's quite right. It's a long-term career, and it takes a while to build up credibility. It's a question, as Sovit was saying, is where are you going to build up that credibility, and how specific is it going to be to you? I think going to a hedge fund, going to an algo company, if that's what you would like, is where you want to start, because you want to learn from whatever position you're in. You want to learn from that. You want to add that to your toolkit, shall we say. So that's always something, to ask yourself is this building my toolkit? And and if it isn't building your toolkit, then perhaps another position would help you in that respect. I would also say that managing money is the most lucrative side of this industry, bar none. And if you are learning how to do that, and if you work for a hedge fund or a company where they are managing money, um, then the financial opportunities are much greater than just being an analyst, or that sort of a thing. That's my experience. That's really where the money is, and it's hard, but at the same time, building your credibility and doing it over a period of time will hold you in good stead. It's maybe again, one has to be patient at the beginning part of their career in order to build that up. But I would go where the money is, and the money is in the hedge funds and in quantitative research right now. That's kind of what I see, right? I mean, I'll just toss out, this chat GPT thing. I mean, it's probably going to have a huge impact on things. And what do we know about it yet? Well, personally, I don't know enough about it yet. And I will be looking at that and trying to understand that. But that's certainly going to, it quantifies things a little more, right? So anyway, that's my thought.
Thank you so much, Sandra and Sir. So one question related to the challenge only. So how would you go about picking up the stocks? Like what would you look at the sectors, or like how would you go about it if you want to pick the stocks?
That's a nice question. If you both were participating in the challenge, what would your process be?
Sandra, you can start.
Thank you. Well, my process would be more of a top down than a bottom up. I guess that's kind of how I would approach it. I would look at what industries are performing, and then I would drill down in that, and I would look for stocks that have a really profitable profile. I don't want to take a chance necessarily on something that's coming out of the base that's been in for 2 years. It may not ever come out of that base for another 3 months or 6 months or however. So I tend to be a top down kind of a person in that sense. The other thing for the S&P 500, I can speak with that, is there are certain sectors that are not really worthwhile if you're in an investment challenge, right? Finance, yes. Communications, yes. Consumer discretionary, yes. Utilities, probably not. Staples, probably not, right? Because those are sectors that their profile isn't such that it's going to maybe give you the opportunity to dig in there and find the gold that's going to win you the challenge. That's how I would do it.
Okay. So my approach is very different from Sandra's. Okay. I'm more of a trend following, momentum, and rated set person. So I don't care about which sector the stock is. Okay. In fact, if I have multiple sectors, it's always better. I have more diversification. Okay. So my approach is more of catching momentum, where the
Mhm.
momentum is, where the latest strength is, latest strength and also added. Okay. So basically, the strength compared to the index. If the stock is more strength has more strength than the index, then generally the probability is high that that will perform. But in the last 20 years, I've been 20 days, 25 days, whatever has happened of the challenge. I've been watching US market very closely, and this approach hasn't worked very well till now. At least if you were using this, you would not have made money for sure. Okay, that is what I've seen. But in the long run, it works. In short run, it will not work, and it generally doesn't work unless it's a bull market. Okay. Also, it can be a bull market in US. I don't say that it's not a bull market, but as of now, it's in a sideways or a corrective phase. Like what happens in a trend following system? Try to understand. Uh, Once you take say you will not enter when not every time you when you enter it will not be a bull phase, right? In a bull market it can be a corrective phase also, right? Or it can be a bear market as well. No, we don't know as of now, right? So if you enter and the market is very very strong, then from the very first day you start to make money, which is possible, but that happens very rarely. In most cases, either it would have turned into a bear market, or it would be in sideways zone, and then afterwards it will move higher. So any of these situations, what will happen is that since our stop losses are closer and our targets are bigger, or we don't have a target, what will happen? We take a trade, okay. If it is a winner, we hold on to it, right? We don't say exit it. And if it is a loser, we exit with a small stop loss. But still, that small stop loss will be at least 5%, at least 7%, at least 8%, right? So initially, your if the stock drops by 5-7%, you'll exit, okay. And those stocks which are running, you will still that will still be there in your portfolio. So there will be stocks which change their momentum, or their momentum physical. You will get stop losses, stop losses, stop losses. So initially, you'll get a series of losses because the winners are still there in your portfolio. You're not exiting it, right? So because of this, your losses will be initially high. The series of losses generally will be high initially, and once the system has identified those 10, 20 stocks or 50 stocks, whatever is there, your number of stocks in your portfolio, which are really strong and which are not giving up, then it will start to move. If the market moves, these will make money for you. These will become maybe 50%, maybe 100% returns. But it will take time for these to develop. Okay, so generally in 2 months, which is the period of the challenge, such a strategy may not perform very well. It will need more time to show its rewards. Okay, but yeah, for such maybe uh, challenges, you maybe something like at least for this period, a mean leverage approach would have worked better, okay, than a momentum approach. Yes, and
I'm a momentum person. I really feel it's important to identify what's moving. I mean, that's it. What is moving, and so the trick is to is it moving, and is it going to keep moving, or is it going to stop, or is it going to go the other way? And so momentum is definitely a big part of the equation. and I mentioned certain sectors because some of them move more quickly than others at certain periods in time, and that is where you can find maybe those particular stocks that you want to look at that will actually move, have moved, will move, continue to move. So I am a momentum person for sure. That's where the money is.
I'd like to add one more angle to this, and so with Sandra, better your opinions. Now, the markets overall have been quite choppy and sideways since the beginning of the challenge, which I think is one of the best learning opportunities the participants of the challenge can have. But even if the markets are choppy, we're looking at a universe of 500 stocks. I would argue that there is an opportunity even for momentum players to find stocks that currently have momentum even within this market, right? So the ability to analyze top down and to get a sense of where that momentum lies, or depending on your investment style and your personality style, and that's something that you touched upon very well in this conversation. Within this universe of 500, I would argue it is possible to find securities that are behaving in line with your investment style. What do you feel about that?
Sandra.
Um, I think let's put it in terms of opportunity. A choppy market is challenging. I mean, that's just the bottom line. It's just very challenging, and perhaps a little more conservative, to be a little more conservative in terms of choosing to go with a stock in a choppy market. Yeah, you have to be really convinced that momentum is real and is going to continue for that stock. It is a challenging market for sure, for sure.
So, Sandra, let me ask you a follow-up question to that. What would your process be to gain that conviction? So, say in a universe of 500 stocks, you're looking at a few that seem to have momentum. What could you possibly do to, assure yourself that there is enough momentum? What would your process be?
Um, I wouldn't consider I wouldn't consider taking a momentum breakout for a stock that has really not been performing very well. I mean, I wouldn't even pause over it. I mean, honestly, um, if it looks like it's held up well over time, and now it's having a breakout in a choppy market, well, you could take a chance on that, right? Because you already have an indication that you know it's a healthy stock underneath it all. The unfortunate part of that sometimes is that the the stocks that behave that way are few in it, few in a choppy market. So then all of a sudden you're in with the crowd, so to speak, right? So you have to be aware that like everybody went into large caps when the banks started to fail, right? Well, that was a crowd move, right? But bank stocks now. What did I say? Large cap. What I meant was large cap during the bank problems, um, and everybody went there. And that's just where the money went, right? And so to have a look at that, but to be aware of that context, I think is really important. But if you're running a quantitative system, it will catch those things for you, right? And I think that. So, but you might agree is really it'll give you the options that you could take, or it will take them for you. I mean that's the other side of quantitative investing, right? Is that in fact your algo is taking those positions for you, but um, in a choppy market, it's very tough.
Uh, yeah, Joel, I'll answer this. Yeah. See, in a choppy market, what happens is that although there are 500 stocks, uh, and you are participating in an investment challenge, you cannot have one or two stocks in your portfolio. Okay, you have to have a more diversified approach, right? So at least you'll have 15 to 20 stocks in your portfolio, right? Now, if you have 15 to 20 stocks in your portfolio, and sometimes what happens in such market is that, and I'll give you some examples also, like uh, in such markets, once there has been a momentum for a very long time, and that momentum is maturing. What happens is that there will be sudden falls in those stocks. Like if you see Nvidia, okay, it was in momentum. We all know that, right? And suddenly it falls by 10%, or it falls by 5%, right? So these things happen because at the end, when the momentum is maturing, it will give you sudden falls, okay, sudden movements, okay. And although you have 20 stocks in your portfolio, the damage of 5% will not be big, but it will not let you multiply your funds. Okay. Uh, Another stock, if you see Oracle, okay, Oracle was in a strong trend. If you see the chart, you can see it. Okay, suddenly yesterday it fell by almost 10%, right? 10 to 13%. So these things will take away your profits. Say you are making money, say 5%, 3%, 2% somewhere in other stocks, but sudden jumps like this takes away your profitability of what you are making in those stocks which are doing good, right?
Right.
So it becomes really challenging because the momentum is uh, at one point of time momentum will also fade, right? It is not that momentum will always remain there. So
Right.
these are the phases where you will be chopped, because you have to manage your risk as well. You have to have diversification, so that becomes tricky at times,
Right.
especially in such moments.
I would just add one thing to that. It's a very important point that Sovit is making, is that momentum does mature and it does peter out. And so, when we talk about momentum, often we think about the beginning part of the trade. Is it breaking out? Is it going to, last? But in fact, when it matures and it kind of goes like this, your algo needs to take account of that, and to be aware when that momentum is starting to drop off. Maybe not the right word, but you can see it. It's just kind of like a little roundy kind of a thing, and so that's a very important part of it. It's just not on the way in; it's also on the way out as well. So.
That makes a lot of sense. In fact, just today's chat with the two of you, I think, has convinced me that we should do a separate conversation just on quantitative systems and how we can leverage what we're learning in the program to develop them. But since unfortunately today we've come to the end of our time, let's hand it back to Kavita.
Thank you so much for this insightful conversation, Sandra and Sovit. And thank you, Pat, for joining. And all of you have a wonderful, lovely day.
Yeah.
Thank you.
Good
Yeah.
luck.
Thank you, Kavita. Thank you,
Thank
Thank
Jill.
you.
you.
Yeah.
Thanks, Sandra.
Yeah.
And thanks,
Bye-bye.
Parth.
Yeah.
And
Nice
really
to see
enjoyed
you
this.
all. Nice to see you.
Bye.
Bye.
Thank you, everyone.
Yeah.